Depreciation. That is the expected loss of value in the vehicle over the term of the lease. It is defined as the difference between the cap cost and the residual, and that makes up the first part of our monthly payment. And it's a very simple calculation. You take your cap cost minus your residual will give you your depreciation. And then I take that total depreciation and I divide it by my lease term to put it into a monthly depreciation. So cap cost minus residual gives me depreciation divided by my term of the lease will give me the monthly depreciation. So let's look at the one that I handed out earlier. We have a vehicle with an MSRP of $20,000. And the first thing we need to do is calculate the residual. So we'll take MSRP and you can just write on the side on your paper. MSRP is 20 times, what's the residual value on this lease? 50% for 36 months. So 50%, and we will get $10,000. And I'm just going to put here GFV, guaranteed future value. MSRP times 50% gives me $10,000 guaranteed future value. Now that I know this part, I can start to calculate monthly depreciation. So I will take my cap cost. Cap cost is 19. That's what they've agreed on this transaction to lease the car for, is the cap cost of 19. Now you have to add to the cap cost what we call an acquisition fee. All leases have an additional fee on there. This compensates the leasing company for the administration of the lease. This particular one happens to be, how much? $500. So I'll take cap cost plus acquisition fee and I will add those together, which will give me my gross, $19,500, gross cap cost. So it's always the cap cost plus the acquisition fee. It will be in your lender guidelines how much it will be. And from there, I subtract my residual value or guaranteed future value, which is 10. And this difference is going to give me my depreciation of $9,500. This is the total depreciation this car will experience for the next 3 years. So cap cost plus acquisition fee of $500 gives me my gross cap cost minus my guaranteed future value gives me $9,500 in depreciation. And I want to put this in a monthly number because remember the lease payment's made up of 3 parts: monthly depreciation, rent charge, and then sales tax. So I'll divide this number by the term. This lease is for 36 months. And we will get a monthly depreciation. $263.88. Cap cost minus residual, total depreciation divided by the term of the lease, 36 months. My monthly depreciation is $263.88. You look like you might have a question, Sean.
I don't even know what to ask right now.
Okay.
That's okay, we'll go.
That's okay, because it will, as we start to work through it, it will become clear. Yeah.
And we have to do all these calculations myself, or the computer do it?
Well, his question is, do I have to do all these myself? Well, at the dealership, you will be able to use your computer systems. Here in class, we want to learn how to calculate it manually. So it helps us understand what makes up a lease.
How do you come
And
to
if your
that?
computer system goes down.
That's true, too. You'll find that you may be one of the only people at the dealership that can do this as well.
Or the customer wants to know how you do that now.
Yeah, we need to be able to explain it to a customer instead of saying, that's what my computer says.
Right.
Okay? So we need to be able to fully explain it to our customers and understand it.
I have a question.
Yes?
Whenever it comes to the percentages, is it always going to be 60 for 24, 50 for 36, 45 and then 40 and so on and so forth?
Good.
Or are those the guidelines?
Yeah, good question. She says, is it always going to be 50% or 60% residual? And the answer is no. We'll have to look at our lender guidelines, and they will tell us what to do with different models and different terms and mileage increments.
Okay.
Okay? Okay, so the second part I need to look at, let's move forward. Money factor. Leases are also, we have to have a lease or rent charge. The lender needs to be compensated for the use of their funds. So when we look at that, it's going to be expressed in a decimal number, not an interest rate or APR, because it's not going to show on the contract. It doesn't need to. They're paying for use of the vehicle. Now this is more for you to know. Let's just say, in this case, our money factor is 0.00199. If you wanted to know, or if your customer should ask you, what does that equate to in interest or APR? There's a formula you can use. You'll always take the money factor, 0.00199 times 2,400. Always use 2,400. It's been converted for you. It's one part of this, one part of that. It will give you an APR of 4.77, not quite 4.8% interest. Just for you to know, if you wanted to figure out what that equates to in APR interest.
So it's always going to be 24.
Mm-hmm. Always 2,400.
That .0019, is that going to be a number that's going to be in the guidelines for the division?
Yes, they will tell you what money factor or lease charge to use in those guidelines. Mm-hmm. Okay, so as we look at it, when I calculate the lease charge, it is saying it's going to be applied to the total loan balance. So for instance, it's paid on the residual as well as the cap cost, because the lender has tied up all of that money waiting for the lease to go to termination. So the simple method is you take your cap costs, which we've already figured, right, at 19.5, and now it says to add the residual. Because remember, the car's out there for 3 years, or lender's waiting for it to come back. So you take the same two numbers you subtracted will be the same two that you add. $19.5 is my cap cost. Gross cap plus residual. Guaranteed future value of 10. And I will get a total sum of 29.5. And it says cap cost plus residual times my money factor, which is 0.00199.
58.70.
58.70. This represents your monthly lease charge. Yes, Ruben.
Money factor. How did you come up with the money factor?
It will be given to you off your lender guidelines. Right now, I've given it to you on the worksheet. Yep. Just like on a regular traditional deal, we look up rates. It'll be the same thing with lease lender guidelines. Yep. So this is my monthly lease charge. Okay, so now I know how much the lender's going to charge each and every month for them to use that vehicle. Yes?
You use the gross cap cost,
Mhm.
not the cap cost.
Gross cap cost, yep. Same two numbers you subtract, the same two that you add together.
I have a very quick question.
Yes?
The money factor that is in the guidelines,
Mm-hmm.
that's going to the leaser, right? It's going to the bank that's actually doing the lease, not to the dealership.
Exactly.
Are
Yes.
you able to change that and the difference go to the dealership?
Okay, his question is, we're getting the money factor from the leasing company. Can he change that? They do have where you can mark up the money factor. You have to look at the lender guidelines and see how much.
And the dealership gets the difference.
And you get to make some, yeah, you would earn some reserve, yeah. Now, I will tell you though, in many cases with some of your subvented lease programs, they don't sometimes let you mark it up. You may just get a flat because they want to be able to still track those payments that they advertise for the consumer.
Yes.
Is that
Yes.
the same thing that we did yesterday? We'll go in and put in the original money factor and then the buy rate money factor and then the 70%
Yeah, so the
participation?
.00199 would be the buy rate.
Yes, and then you could figure out the markup from there.
Yes.
Yes, it'd be the same way in the computer. Mhm. Good questions. You're thinking ahead. Okay, so we have this so far. We know our monthly depreciation. I'm just going to move it over here. And I'm going to add together my monthly lease charge. And then when I add those together, it will give me my base lease payment for this transaction. And what do we get?
322.58.
Okay, 58, 50, close enough. Yeah, 322, 58,
I'll go with
depending on how you move your decimals. So it's 322.60 base lease payment. Okay. So now I know lease payment. I know the base because I've added it up. The one last thing I need to do is your taxes. And I will take that. We're going to use for us.
Is that too much for you?
We're going to use 7.8%. So our taxes at 7.8% will be $25.16. And then we'll add that to the base lease payment, which will give me the total payment for our customer. $347.76. So I took the base payment of $322.60 times 7.8%, gave me $25.16 for a total lease payment of $347.76.
So the base payment times the 7.8.
Mm-hmm. And then I add that to my base lease payment. Question?
I answered it in my head.
Okay, perfect. Good. So we did 3 simple steps, right? We did our monthly depreciation, monthly lease charge, and then we taxed it to get our total lease payment. So if a customer says to you, how did you get the payment? Well, it's made up of 3 different parts. And you can start the conversation that way. Okay, any questions? Let's go into the computer and see if we have it right. Let's see where we're at. So one to create a deal once you sign in. Okay, got a few just still checking in.
Thank you, son. I got news. I didn't see it. Yeah.
Now it tells us our residual or guaranteed future value is 10. Our base payment is $322.60. With a tax of $25.16, your payment should be $347.76. Much easier, but we did it right. How about that? How about it? Now, where it says drive-off fees are right here, $897. That's what the customer would have to pay. In fact, if I go in and hit F1 on drive-off fees, it will give me a breakdown of what's in those fees. First payment, looks like security deposit. It will show me what's due. And when I print a contract, it will itemize this as well. So we'll go back to the deal screen. Now go all the way down to the monthly payment and hit F1. Hey, look at that. It's exactly what we did, right? We have monthly depreciation, $263.89, monthly lease charge, $58.71, base payment, $322.60, plus tax, $25.16. Our payment's $347.76. For 36 months, this number here just shows the total payments times the term would equal $12,519.36.
So essentially they're paying $12,000 to drive the car for 3 years.
But you can turn in and walk away. What typically happens on a 6-year loan is at the end of the 3 years you go trade it and you owe considerably more than the car's worth. You're upside down. So this is just, it's a wash.
You can buy it out the end if you
You can, if you want to, yeah. It's an,
Over the term, you'll end up paying more, am I right?
No, you wouldn't know because it's agreed
If-
upon. You have a certain amount of money
At the,
left over.
if you, let's say, you put 2 car deals side by side, one is purchasing the car, at a great rate because you got good credit or whatever. The other one is leasing it. At the end of it, if you buy that lease out, the total amount of money that you spent cumulative on each side, which would be more.
Oh, maybe because the lease is gonna have the lease fee. and stuff into it.
it just depends on so many things. Sometimes it could be